doing next is, before talking about write-off, this is another method. The header is aging of accounts. Remember, we have two different methods of allowances. So percent of sales is one, based on the total credit sales. Aging methods is another way a corporation could estimate allowances. So you see this table here, the left-hand column, there's all the customers that have been dealing with transactions with this corporation. And we break that down, the accounts receivables, into different time periods of ages. So you have only a 1 month old accounts receivable accounts, 2 months old, 3 months, and more than 3 months. And here, the critical part is that the percentage is assigned here. Okay, so in each and every problem, you'll be given these percentages. You don't have to worry about memorizing these. So the percentages here basically gives you the possibility of not collecting the money on time for different different account ages. It's different. So the younger ones, we only assign 1% of likelihood of not collecting it, 2% for 2 months old accounts, 5% for 3 months old, and over 3 months, you may assign a very high percentage because it has been past due for more than 2 months. Okay, so there's a 90% here. Overall, what we're doing is the total amount of accounts receivables times these percentage to have a dollar amount of uncollectible balance, and then we add them up all together. Okay, so meaning that 1 month old of accounts receivable altogether worth $18,060 for multiple accounts that you just dealt with in this month. So the total percentage of uncollectibles we assume is $19. Okay. The 2 months old of accounts receivables, we assign 2% to it and assume that there's only $4 that we will not be collecting. So 2 to 3 months old, we assume there's $17, and over 3 months, we assume $360 of this $400 would likely not be collected. And we add up this last line here to get to a total balance $400. This is the target balance of allowances that we're looking for. Okay, this is a target balance of whatever was reported there in prior year. We assume at the end of this year, it will be altogether $400. Remember, this is also a permanent account, so you will have a balance from last year already. So assuming last year's balance was just 100 for all the estimation that happened last year, this is this year's target balance. And we want to adjust the entry. Allowance is estimation entry for $300. The difference is between the two. Okay, once again, oftentimes companies use this aging methods at the end of the year, at the end of each year. So last year end, you have this exact same table, just probably the client name is different, and the ages dollar amount is also different, but you do the same thing as assign a percentage times the total balance of accounts receivables. So assuming last year end, the balance is 100, and in this year, after this table of calculation, the balance is 400, and we want to measure the difference to $300, and again, journalize this entry. Uncollectible account expense, allowances for uncollectible accounts. Okay, so what you get at the end of this is the target balance of allowance account. And you calculate the differences between last year's balance and this year's new balance. So $300 is the part that we want to additionally estimate for this year. And so first step of this is really just to fill in customer's name, fill in the dollar amount of the transaction that you dealt with them in different entries, and categorize them based on age. And companies will send percentages of uncollectibles to these different age of accounts, and we calculate a balance of uncollectibles based on those percentages, and then add them up, figure out a target balance for this year end. So this $400 is the total part that we're assuming we're not getting from all these customers on time. Okay, and then this $400 may not necessarily be the dollar amount that we want to journalize. We're just journalizing the differences between $4,400 and last year's ending balance. Okay, but if last year, let's say it's the new company, last year was 0, then $400 would be the total amount of investment. And if last year there was a balance, which likely there is, as long as the company has been operating well. And the difference is the amount that we want to journalize. Okay, let's take a look at the numbers here in the following slide. So here's an example that accounts receivable ending balance is $2,800. Using this aging of accounts method, last year's balance was $150. This year is $400. So the difference here is $250 between those $2 amount. That's the part that we want to journalize as additionally uncollectibles for this season, for this year. Okay, so the debit credit dollar amount is the same for both methods. For percent of sales, we're using credit sales times percentage. You debit credit these two accounts. For aging of accounts, the same journal entry. Debit account for collectible expenses, credit allowances. Just the dollar amount, how we arrive at the dollar amount is different. Okay, we want to make the adjustments. Last year end is $150. This year our target balance is $400. So we estimate an additional $250 here. So for these two methods, company can decide which one to use, but oftentimes corporations do a monthly basis estimation on percent of sales, and then at the end they do a whole table of that aging of accounts to match up. Additionally, is there other adjustments that they want to make? Okay, so oftentimes this occurs at the very end of the year. Percent of sales may happen frequently at the end of the month. But altogether, the purpose is the same. We want to estimate a pool of uncollectibles. So after this estimation, again, net realizable value, we're just using the 400, subtracting it from accounts receivable. So just like earlier, allowances, any dollar amount that appears here, subtract it from accounts receivable to figure out the net realizable value. Okay, so this part is the same as percent of sales. Meaning altogether, we're expecting to collect $2,400 of accounts receivables on time from all of the customers. Okay, I'm going to